Hello, everyone. Hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was reading a comment. Someone was asking about the comment of money velocity. And I'm going to touch on money velocity because a lot of people say if you don't get the money velocity to go up, you're not going to get inflation. I think that's partially true, but false. And I'm going to give you my opinion. This is from just looking at the equation. I don't care what other people say. I don't care the narratives. I don't care about any of that stuff. I look at the actual equation. So if you look at the equation, it's VT is the velocity of money for all transactions in a given time frame. P is the price level. T is the aggregate real value of transactions in a given time frame. And M is the total nominal amount of money in circulation on average in the economy. Now, money gets created, and there's an exchange that happens. Bonds come from the Treasury, dollars come from the Federal Reserve, and it goes into the commercial banking system. A lot of people say you can't get the money out of the system, the commercial banking system. But in an expansionary phase of real estate, they're making new loans against new homes, which is inflationary and creating and expanding the money supply. That is the gateway of that money from the commercial banking system into the wild. Now, looking at this equation here, there's a couple things that you want to look at for the equation. So velocity equals the price level, and T is the aggregate real value of transactions in a given time frame. Just think of it as time. So it's price level times time divided by the monetary, basically the total amount of money in the economy. Well, if they're just piling money into the banks nonstop, well, that's increasing M, right? The total nominal amount of money in circulation on average in the economy. Maybe that's what they include in there. Well, if they're just continuing to pile it in there, I mean, the banks are just going to go invest it in the stock market or something? It's not really flowing through the system. I mean, it is in the system, but it's not really exchanging. So it's going to slow down the velocity if you just, increase the total nominal amount of money in the system. Now, the markets are naturally deflationary. If you're producing a product, and my degree is in manufacturing engineering, what happens? Why do people hire me? I'm there to increase efficiency. I'm a lean manufacturing person. I'm a continuous improvement, trying to gain efficiency in building something. Efficiency is manifested with lower prices. So your price level, if the monetary units are flat, is going to go down unless they increase the money supply at a faster rate than I can increase the efficiency of producing products. Or you've got commodity prices going up with supply-demand imbalances, but usually you have technology that goes into that as well, and then you're fighting declining ore grades. So we've got the price level here, and then you've got your time. If your time's held constant, you can throw T and just throw that, in the trash. So really it's the price level over how much money is in the system, right? That's your velocity. Because if T is a fixed thing, if we're not changing the time frame, well then that's fixed. We're not changing that. So this is a constant basically, and your P, it's P over M. It's your price level over your monetary, over your money, how much money in circulation on average in the economy. Well, if they're just piling in a bunch of M, of course your velocity is going to slow down because your T is held constant. And if your price level doesn't go up, if the money doesn't get into the system, if it's just piling into stocks and bonds, well, yeah, of course that's what's going to happen. Your velocity goes down. So you can have money in the system circulating faster and your velocity goes down. So your price can go up, but as long as your monetary base is increasing faster than your price levels, your velocity goes down. So you can have inflation and have your velocity go way down. You can have increasing inflation rates and your velocity goes down if they just continue to pummel money into the system. In fact, they're going to have to, because they're going to have to hold interest rates down, right? That's what all that QE is. You think that's getting into the system? No, but they may count that in your M. And I don't know if that is or isn't. I don't know for a fact if that's counted in there as the total nominal amount of money in circulation. But I can tell you for a fact that if M grows faster than P, your velocity goes down. And I know some of this gets stuck in certain areas. So here's the takeaways. The velocity of money is a measurement of the rate at which money is exchanged in an economy. The velocity of money equation divides GDP by money supply. Gross domestic product by money supply is how it's calculated. The velocity of money formula shows the rate at which one unit of money supply currency is being transacted for goods and services in an economy. And the velocity of money is typically higher in expanding economies and lower in contracting economies. Now, there's a whole bunch of economies that have hyperinflations with contracting economies. So yeah, I think you can have inflation. Here is the actual money velocity here. So we're going down, but we're actually blipping up higher and coming down a little bit. This almost looks like a lead-in, like we're going to head higher. And maybe we can even see if this is like almost the same as the lead-in for some of our patterns. But if this just goes sideways, I think you'll see high rates of inflation. Now, let's look at the money supply. Let's look at the denominator here. Well, look at that. It's going straight vertical. It's going vertical. Well, if it's going vertical, and that's in the denominator, well, that means prices are going to have to go vertical for velocity to go up. If we have velocity go up, and this is in your numerator, well, you'd have to have GDP go at an exponential clip. So what I'm saying is I don't think it's possible for our GDP to go at a rate that's anywhere close to what they're doing with our money supply. So the velocity has to go down based off of the equation. So then the question is, can you have inflation with the velocity going down? I would say definitely. Definitely you can have inflation. And it's only as much money as you can get into the system through the expansionary phase on those loans against the real estate, the new homes against new loans against new homes, which is inflationary. Now, how is it going to compare to this in the background? I mean, if they're going vertical with it, then it's probably not going to keep pace and your velocity is going to go down. But notice that the velocity is going flat. So if this is going vertical and we have flat velocity, that means we're going vertical in inflation. So if we have a flat velocity with them doing this much money printing, well, the velocity could be held constant, but there's so much more money in the system that you'd have massive inflation. You could have hyperinflation with the velocity being just flat. Because if they're printing that much money and dumping it all into the system, and then the price levels stay equal to this money supply increase, so the velocity is just flat with a 50% increase in money supply or 20%, that means your inflation's that. They're just lying about it. So that's my opinion on it. I obviously, you know what? I haven't gone in and read a whole bunch of economic books. That's just looking at the equation and drawing to some conclusions. The conclusion that could be wrong is how much money is in the monetary base and what they include in that money in circulation, the entire amount. If it's the M2 money supply that they're putting down there, which according to this, it's by money supply, and I don't know which money supply they use for the velocity calculation, but if it's M2 money supply, which is right behind me here, that goes vertical like this, you could have a flat velocity and have massive amounts of inflation. So I think it's all relative. So that's my take on money velocity, and I honestly don't think it's a big number to really worry about. If the money velocity goes up, which I don't know how you could do it. I mean, if they're printing that much amount, if they're printing trillions of dollars, and we didn't even have $1 trillion in circulation, some while back, I don't know how you can have an increasing velocity ever. Our GDP is not going to grow. Our price levels aren't going to go up that high, our GDP. So I don't know. I mean, that's the way I look at it. I think just looking at the equation, and if they're printing that much amount of money, if we just have flat velocity, we're going to see massive inflation. If you guys like this content, give me a thumbs up. Thanks for listening. This is Finding Value.